Hello, my name is Paul Harden. I'm the area director for the greater Newport area. And today we're going to talk about some of the things you need to do to sell your business and some of the things you need to think about in regard to selling your business. Uh, it's a number of steps you need to do. And I think the biggest thing is the earlier you start, the better it is in the process. Why people sell a business is often discussed. Here are some, you may just want to retire. Another reason is that the business is not really financially sustainable. It's losing money or close to break even, and it doesn't have the resources to grow. You may have personal health reasons, or a family member may have health reasons that are making you consider selling the business. You're just tired of running the business. I've met people over the ages that have said, I've done this for 30 years. I'd like to do something different or move to a different area and open up something else. And finally, the business needs to be recapitalized for growth. And what that means, it needs a major injection of cash to grow the company to the next level. The business is doing well, but it's not going to get to that next level unless someone else comes in and puts more money into the company and to better position it for growth. The timeline for selling a business. The more complicated the transaction, the longer it takes. If you have multiple owners of the business, multiple locations, that all takes longer. But it may be on a short scale, 3 months, it may be 2 years. I dealt with what I thought was a reasonably simple business. It took us over 2 years to close. The owner's husband died in the process. We had COVID come in during the process, so there are a number of issues that tended to delay closings, and things like that will happen with any business. And the other thing to realize is 80% of the businesses that are listed on various websites or by brokers are never sold. I don't know why that is, but I've heard various thoughts that the businesses aren't really prepared to be sold or aren't realistic in their pricing. So the sooner you start this process of trying to sell your business, the better. All right, certain first steps. So determine a purchase price and look at what that includes. You don't want to say to somebody, well, make me an offer, or what do you think it's worth? I've seen that a couple of times, and it just doesn't make for a smooth transaction. And don't have a range, saying, oh, somewhere between $1.5 million and $2 million. Say I want $1,750,000 or $1.8 million. And that's the number for the basis, because if you say between $1.5 million and $2 million, the seller is going to think 2 million and the buyer is going to think $1.5 million. So the purchase price should also include the payoff of any debt you have. If the business has loans, the buyer would expect those loans to be paid off upon closing. Rarely would they be carried on past the closing, even though they were taken out by the company. Another important thing is to put together a list of assets that the buyer would get. So when he buys the business, what are the assets he's getting? Machinery, equipment, inventory, vehicles, raw material, computers, things like that. But you should be able to say to the buyer, here's what you get with the purchase. Then another question is, do you as the owner have a future role in the business after the sale? Is there a transition period between the closing of the business and when the former owner actually leaves? Is it 2 weeks? Is it 6 months or a year? It's really what you and the buyer are comfortable with as a seller. Some businesses may require longer. Some, if the owner has a lot of experience in the industry, he may not need any assistance for transition. Sometimes also, as the seller, you may be paid a certain amount over a time period to continue to be involved in the business and help with the business. So, but that's something to think about. Some people want a future role. Some sellers don't want to be involved beyond a couple of weeks or a month. And finally, the price of the business is really determined by what kind of money the business makes. You'll have businesses that have a lot of assets, sometimes in real estate, but the earnings don't justify the value of the real estate. But the earnings are really what drives the number. And primarily those earnings come out of the tax returns. I mean, you can say you have earnings and have certain indications of those earnings, but the lenders and the banks and the buyer is going to look at what are you reporting on your tax returns? And generally they'll look at the past 3 or 4 years. Gathering the documents for buyers. This is what they'll really want as a minimum. 3 years of the business or personal tax returns. And at least 3 years of the P&L and the balance sheets. If you have that, you're in pretty good shape. The banks will require that to look at that. Other things that are helpful are copies of any leases or contracts that extend beyond the closing date. So if you have a lease on a facility that's 10 years and you're 2 years into it, generally the buyer would want to see the contract or the lease agreement. If you have equipment that you're leasing, if you have certain contracts with customers, you need that. The history of the business is helpful, so the owner, the buyer, can get some perspective where it's coming from. How many years ago did it start? Were there partners involved that left the business? Things like that. And then a list of the assets and inventory. Both in inventory, both if you're a manufacturing type company, raw material and finished goods. Sometimes you'll see a manufacturer that has a lot of finished goods, but for some reason, those finished goods aren't saleable. They're either obsolete, they're broken, there's some issue with them. So you want to make sure that as a buyer, you aren't paying for inventory that doesn't have a real value and you can't liquidate. So, but the sooner you can put these documents together and keep them current, it's important. I'm working with a company right now that we're trying to get 3 years of the financial statements together, and it's surprisingly difficult. So if you have them and can deliver them, that's good. The next step is putting together a marketing plan for the sale. And this needs some thought and some planning on your part as the seller. Who would be the interested buyers? An example of this is if you have a small local restaurant, it's not going to have interest beyond your region. You're not going to have a national pool of buyers generally. If you make a product that you sell nationwide, you're going to have a different type of buyer. Try to understand why people are interested. Is it the reputation of your business? Is it the quality of your product? Is it your location? Is it a combination of those factors? So it's understand what sort of the important point of your business. Again, what advantages does buying your business give them? Many times, people have the debate, do I buy a business or do I start my own? And there are advantages to both. But one of the things I like about buying an existing business versus starting your own business is you've got one less competitor in the field. So you don't have someone competing against you. Then you need to think about where do you market it, how do you best market it. Marketing a business for sale can be difficult. But you can use email, you could talk to sort of industry people. If there's an industry association or a business association, you can put the word out. There are various newsletters out there that have businesses for sale in them. There's trade journals that list businesses. So there's a variety of means to market the business. And then another option is using a business broker. There are individuals out there that generally will specialize in certain types of business. You may find somebody who does restaurant brokers, or I've seen convenience store and gas station brokers, things like that. There are pluses and minuses to using a broker. There's a fee generally associated with a broker in it, but they also know who are the interested buyers, and buyers come to them looking for businesses. So if you want to move it to more quickly, there may be some benefit to using a broker. How do you market it? Some people I've seen examples where people send out emails or letters to targeted customers and have a blind email box and say, if you're interested in finding out more, please contact me. Don't use your company's email address because they'll know right away who it's coming from. And then the other thing you want to think about is, do you want to make the sale public, or do you want to keep it quiet? I also noticed I misspelled quiet there, sorry. But that's an important thing to look at is, more people are going to know about it, but there's going to be a lot of gossip about it, about making it public. It may be hard for your employees. Your competitors may use it against you. So generally people tend to keep it quiet as long as possible. Some people don't care what everybody says and just list it with a broker, and it's out on the market, and relatively quickly everyone knows about it. But I think what you need to think about is, here's a marketing plan you need to put together, and how you're going to implement that marketing plan and the time it'll take for you to start marketing that business out there. Recently I've seen real estate brokers begin marketing businesses. It's an option. It oftentimes is in conjunction with the real estate, but understand that a real estate broker, while they're very talented at their job of buying real estate, they're not really experts in buying and selling businesses. So, it may work, but it may not too. So just be cautious of that. And we touched on this earlier, the potential buyers, local restaurant or retail are really going to appeal to local buyers. And therefore your marketing should be targeted locally. If you're doing something that has nationwide sales or overseas distribution, you're going to be attracted to larger buyers. And then the other thing is, do you need a buyer who is going to invest both to buy the business, plus they'll need to put additional investment into your company to grow it, or can they grow organically? Sometimes businesses can generate enough cash flow to grow on their own. But oftentimes, besides buying the business, the buyer will need to put additional capital into the business to really take it to the next level. By a lifestyle business, there are businesses out there, and the one I'm most familiar with is business in the marine industry. But there are other sort of hobbies or things like the golf industry, that people buy a business because they like golf, they like boating, they like this. And being in the field affords them certain benefits. And certain companies have a lot of appeal to people if they're in a lifestyle business. And then another question is, can your business be relocated? Can someone pick it up and basically move the whole operation to somewhere else? For manufacturers, if it's a mail order type company, a lot of the business can be relocated elsewhere. If it's a restaurant, it's going to be more difficult to relocate outside the area that it really serves. But that's something you need to understand and think about is it feasible to relocate it? And then what are the issues with relocating it? Because it could be a question for the seller that the buyer would want to discuss. We talked about some of this. Marketing the business for sale depends on the type of business and the area of the business. Ways to market the business. We talk about trade journals or websites out there. Almost every industry has some sort of industry association that lists a lot of the businesses. Using a business broker, we talked about word of mouth, just getting the word out. Other ways may include talking to your attorney, talking to your accountant, talking to other people you work with in the industry. They may have come across people that are interested in buying a business of your type at some point. So you found an interested buyer. Now what? This is where it gets a little difficult. The first question you need to ask is the buyer qualified and do they have the industry related experience? The reason this is important is if they're going to finance it through a bank, the bank wants to see transferable skills. So they don't want to see someone, if they're buying a certain type of manufacturing company, that they've never worked in manufacturing before. It's important that they have some transferable skills. It doesn't have to be one for one, but they need to convince the lenders that they're qualified to run the business. Or for a larger business, can they put a team together that's qualified to run the business? I've seen with restaurants where the buyer is actually really just almost a silent partner, but he's putting a team together of a manager and other people that have extensive experience. Another important question that you should be asking as a seller is, can the buyer get the financing? And, I don't think it'd be unreasonable to, ask the seller as you move along in discussions, would you mind talking to his bank? And you don't need to know all his personal financial issues, but you say, we're looking for this amount of financing. Is it reasonable to think that the buyer could get this financing? Another question you may want to say is, have the buyer talked to the bank about financing? If they haven't, they should pretty quickly. And it's not, they don't need to know, the bank doesn't need to know exactly what's being financed, but they want to know some of the details. And then what you need as the seller to disclose to the buyer is lawsuits, potential or real environmental conditions. One of the biggest ones for certain types of businesses, underground storage tanks. You'll see them referred to as USTs. Some businesses out there have tanks that aren't active but have never been really closed. The tanks are still in the ground. Are there certain employee issues that that the buyer should be aware of? Sometimes, especially in older businesses, certain employees may have different arrangements about their benefits and their pay than other employees do. And it's important for those to be disclosed to the buyer so they understand that. I was involved with a business at one time that certain people who've been there a long time had different arrangements on their healthcare insurance or had extra vacation time. And until we got going with the business, a lot of that wasn't disclosed by the seller, and we didn't find out about it until later. And more importantly, none of it was documented. It was all sort of things that the prior owner had agreed to, but never really documented it. It should be at least a memo to the personnel file saying on this date we made this arrangement with this employee for a certain time period. Off-balance sheet financing. By this I mean there's leases don't have to be put into a balance sheet, but there's still a payment you make every month for a piece of equipment or sometimes a vehicle or other types of equipment. But they need to be disclosed to the seller, to the buyer, and so they understand what they are. And then the other issue is real estate leases. If you're in a building or facility that's leased, what are the terms of that lease? Is the lease assignable to another operator, or do you have to write a whole new lease? If it's assignable, how much is left on the lease? Is there an option, is there a 3-year option or a 5-year option to extend the lease? All those issues should be disclosed to the buyer. While you may not want to disclose them, the buyer at some point is going to find out about it, and it really could put a wrinkle in the sale of the business. Financing the purchase. I think most sellers want to find a buyer with all cash, but the buyer will probably need to seek financing. But you want to make sure that if the bank's going to require 20% down, they have at least that 20% in cash to make up their share, and if not more. Another thing I've seen is oftentimes the buyer may request that the seller be prepared to hold a portion of the debt. And sometimes the seller is, sometimes they're not. It really depends on the individual situation. But understand, if you do, you're generally behind the bank. And by that, I mean, the bank gets paid first and you get paid second. And in case it falls apart, the deal, the bank will get their money and you'll get whatever's left. So there are risks to doing it, but sometimes it's the only way to make a deal work. Understanding how the accounts payable and the accounts receivable may impact the purchase price. Some businesses have large accounts receivable or large accounts payable. It just may be the nature of the business that they'll run up a large accounts payable, but then when they get into the busy season, they'll pay that back down again. Other ones, they may sell to people with different terms. And that's one thing that sellers need to disclose to the buyer, that certain customers may have different terms of payment than what's stated on your invoice and things like that. But generally, you want the accounts receivable and the accounts payable to be somewhat equal. And if not, you may have to either add or subtract cash out of the deal to make them balance. Many deals require multiple loans. And by this, I mean, it's not, you don't go to the bank for one loan because the banks will loan for a longer term on real estate versus other assets and goodwills for a line of credit. So you may have a 15 or 20-year loan on the real estate versus a 10-year loan on machinery and equipment versus a 5-year loan on goodwill. So oftentimes there are multiple loans. They don't have to be all done by one lender. Oftentimes they are, but sometimes you may have multiple lenders in on the deal. For example, one bank may do the real estate and another lender may do the sort of the hard assets, and someone else may do a line of credit. So, but what it means is multiple applications for lending and maybe work with multiple banks on the deal. And again, we get back to earnings. Do your earnings support the debt purchase price? And what I mean by this is, can your earnings support the debt service on the various loans? And what kind of cushion do your earnings have? The banks may want your actual earnings to be 130% of what your debt service is. They want a cushion in there in case things slow down or change. That you've got the cash, they're not you, the seller, but the buyer has the cash coming in to support the debt. So. Next steps. Generally, there's two steps in a purchase. One is a letter of intent, and that is just a general interest in purchasing the business. That the seller and buyer will sign. It has various conditions in it, but one of them may be that the seller stops negotiating with any other parties. It gives the buyer access to all requested documentation. It would also allow the buyer to go in and talk to key employees, customers, and suppliers. And at the end of that period, the buyer really says, yes, I want to go ahead, or no, I didn't like it for this reasons. So, or the buyer may choose to say, change the terms, saying, I thought it was worth 500,000. I think it's really worth 400,000 after I do my due diligence. So, and you as the seller can decide what you want to do, but it's generally for 60 or 90 days. But it's a key step. The buyer will begin to spend a lot of time sort of investigating your company, looking at various records in your company, looking at sales to make sure the sales you're reporting is what you actually have. making sure you're making the kind of profit you're reporting. You may have accountants in there looking at your numbers and trying to give the buyer some confidence that what you're indicating is actually happening. Step 2. So once you have the letter of intent, the next step at the end of the period of 60 to 90 days is moving to purchase and sales. And at a minimum, that would include how much the buyer is paying for the company, what's in the purchase, what's he getting in the company. That's important to outline because sometimes there's a lot of personal assets in a business that the seller will want to keep, and you need to be clear what that is. I've seen businesses that have had, for example, artwork that the owner put into the company, and when it's sold, the owner wanted the artwork out, but there's some question about that. And then what's the time frame for closing? And usually that may be 60 to 120 days. And that really depending on how complicated the financing is. Most purchase and sales agreements are dependent on financing. And they may have a time frame in there that says that the buyer has to apply for financing within this time period, and you have to let the seller know if you've been approved for financing. But generally, if it's a buyer that needs to obtain financing, it will be conditional on the financing. But you don't want to wait to the last day of the purchase and sales agreement to find out that the buyer couldn't get financing. And then again, many banks would want to see a signed purchase and sales agreement, for example, as they do with a residence, to begin to do their due diligence on the financing, on the loans the company's applying for. And then finally, it could have other issues or concerns the buyer wishes the seller to address at some point. An example of that is there may be certain buyouts with certain employees to retire. There may be certain agreements with customers or vendors that the seller would inherit, but it's important to get those all out on the table as soon as possible. And also, if it's a company with multiple owners, you need to make sure that all the owners agree to the sale of the company at the price. And I've seen deals that sort of fallen apart when one of the owners wouldn't agree to the terms that the majority owner had. And they're basically holding up the sale based on a very small percentage of the company. So that's another thing you need to be aware of, both as a buyer and a seller. And then at the closing, which will occur at the end of the time period of the person's sale, it's really when the transfer of the ownership of the business is made to the buyer and the payments made to the seller. That's in a very simple sense, but I've seen a business where the owner and some of his key executives, they'll be at the closing and they'll turn in keys, turn in credit cards, turn in company vehicles are driving, and it may take place over a couple of days. But realize that once you start this process, it may get held up, but hopefully it goes through smoothly. And then you need to communicate with the employees, but what do you tell them? Sometimes the owner will walk around the day before the closing and say, this is happening tomorrow, and really take their questions. I've seen other cases where the owner will walk around with the buyer and talk to all the employees and let them know. And it's important the employees understand that there's a new management team coming in that's taking over the business, and you as the seller don't have a role in the business anymore. Understand that after you close, it's strange, but you don't have a right to come in the building anymore. And if you do, you should really notify the new owner that you're coming in. And then the other issue is to talk to all your customers, your suppliers about the change of ownership. You don't want them to hear third hand, sort of. It's better they hear firsthand. And some businesses may require approval from certain vendors that someone's taking it over. It just can't happen between you and the seller. The vendor may require that they approve the buyer as an agent for their company. One example would be new car dealerships. So if you buy a new car dealership, you have to be approved by Ford or General Motors or whoever to take over that dealership. So, and then explain whether the seller, what your role is going to be going forward. Both to make sure the buyer understands it, and also make sure the employees understand that too. But because you want your employees working together to make the company successful for the future owner. And people get nervous around a change of ownership. You can't help it, but it does happen. Questions? And I think we're going to have another one of my coworkers help me with this.
Great, thank you so much, Paul. That was amazing material there. Yeah, there are some questions. So one I wanted to start with is, how long will this take to sell the business?
It really depends on the type of business and how much you're going to put into marketing. I mean, I've seen businesses sell in less than a month, but generally it may take a year to 18 months. So it's very hard to say how long. There's no set time frame. It sort of depends on where you're marketing it, who you want for buyers. I've heard cases of certain people I don't want anybody in this business to buy my business. So you've got to work through those kind of issues. But
great. So it just varies case to case.
Yeah, it generally takes longer than you think it will.
Okay, so definitely plan ahead.
Yes.
Okay, next, should the seller participate in the financing?
That's really sort of an individual decision, but realize that the deal may not get done without you participating. That either the buyer doesn't have enough cash to really make up the down payment the lender's requiring. So you may have to participate in it. Sometimes buyers or sellers are happy to do that. Other times that they don't want to be involved in it. But realize that you should at least think about that option and be open to it if you need to be there to make the deal work. So
great, thank you. And you did mention goodwill. I just wanted to clarify what exactly that is. Goodwill
is really the value of the business. You've been doing business for 50 years. Everybody knows, ABC company. It's what you're paying for that value. So you may see deals where you're buying the assets plus a certain amount for the goodwill, and it's very negotiable. And I've seen companies that sort of say, yes, but I'm not going to use your name anymore. I'm going to move the business, so I'm not going to pay anything for goodwill. And so it's just something to understand that there is a value to that. It can be called different things in other businesses, but it's generally sort of what the value of the business and the history of the business.
Okay, so if I were to buy a new business or buy an existing one and the name was well known, that would be a portion of goodwill.
Right. If you had the pizza place that everybody goes to, you're paying for that, and you're paying something beyond the value of the assets.
Okay, awesome. Thank you for clarifying that.
Yeah.
And next, is there a role for the seller after the sale?
I mentioned that a little bit in our presentation. There definitely can be. Oftentimes there is, and it sort of depends on how technical the business is and how much experience the buyer may have in that industry. And sometimes the buyer is more than happy to have the seller continue on. They may have a slightly different role than what they did when they owned the business. But it's something you should think about as a seller is, do you want a role? Are you able to do that? I mean, some people just have a hard time working for someone else in a business they grew over X number of years. So, but it's just something to think about, at least put on the table to the buyer saying, I'm willing to have some arrangement to stay on after the sale. And it's really up to the buyer to do that, make that decision.
Awesome. Thank you, Paul. And how do I get the most for my business?
A part of that is having all the documentation together, being able to explain what your earnings are. If you had a bad year, being able to explain to buyers why you had a bad year, what happened that year. But a lot of it too is just what's the physical presence of the business? Is it clean? Is the inventory, is it in a pile in the corner, or do you have it, organized on shelves? Does the place need painting? Okay, it's a lot of sort of, I'm not sure what you call it, but how do you sort of spiff your business up and make it look better? Is it clean? Are the floors mopped? I mean, it's, I'm always surprised when you go into some businesses and you just get a feeling they're not well taken care of.
Mm-hmm.
I think that may turn off potential buyers.
Absolutely. So it's kind of like when you stage a house, you're staging your business.
Yeah, I mean, it drives me crazy when I'm not a smoker, but when you walk into a business and there's a pile of cigarette butts outside in the corner, okay. So it's just, you're selling something you devoted a lot of your life to, put it in the best light.
Right.
And my best word of advice is have someone from the outside look at it, because as an owner, you get used to looking at it and it doesn't seem to be offensive to you. But you bring in somebody who is and say, what can I do to make my business look better? And it's things like, I mean, even I know one company, you walked in and the employees had things taped up on their dividers and their walls and everything like that, and the owner hated that. And he went and bought bulletin boards for everybody to put up if they have memos they want to keep. But don't be taping things on the wall.
Yeah, right.
It's a lot of odd things. It's just so a company, if they have uniforms, are the uniforms clean? Okay, are they looked after? So
we would hope so.
Yeah, you'd hope so.
Great.
Other questions?
I did have one extra one. This was
Sure.
Basically, what are the biggest mistakes made by people that you've seen who do go to sell their businesses?
Biggest mistakes made by people in selling a business?
Mm-hmm.
I would think overvaluing the business, because people, if it's overvalued, they may not even look at the business. They're saying, you want how many million for this pizza place? Okay.
Right.
And they don't even look at it. And so that's a challenge for business. You've got to sort of price it realistically. And also, I think, a lot of businesses go out of their way to minimize taxes they're paying, but at the same time, minimizing their earnings. And again, the value of the business is really driven by the earnings. So it's hard to say to somebody, well, we made 100,000, even though we only reported 20,000. And that's why I say you've got to be realistic about what you're showing on your income tax returns. And while people don't want to pay taxes, it impacts you in the value of your business.
Wonderful. Thank you for the answer to that.
All right. If anyone has any other questions, please reach out to me. My email is pharden, HARDEN @uri.edu.
Great. Thank you so much, Paul. I appreciate all the information given today, and we wish you the best of luck with your business, and hopefully you can get everything figured out to the best ability with the resources we have given. So thank you so much, Paul.
Thank you. If you have any questions, please call us, contact us. Thank you.